I hope everyone had a nice lunch. This is always the most challenging panel after lunch. I have a rule as a professor, I never like to teach right after lunch. But we have such an exciting panel and we had such an exciting lecture at lunch that no one will fall asleep. I am sure of that. We have a wonderful panel today. We're going to be discussing whether the bold, modest, big, small proposal that we heard, it will save Europe, and how it can save Europe if it will. I'm Jeremy Suri. I'm a professor of history and public policy here at the LBJ School and in the history department and at the Strauss Center here as well. And I'm delighted to have the opportunity to chair this panel and introduce our speakers. I will introduce the speakers in the order in which they're listed before each of them speaks. And they will each have a maximum of 20 minutes, 15 preferred, but a maximum of 20 minutes for their presentations. So our first presentation will be from Jörg Bibel, who is the Associate Professor of Economics at Skidmore College in New York. He's also a research associate at the Levy Economics Institute, and he's the author of many publications, as are all the authors on this panel. In particular, his book, Keynes on Monetary Policy, Finance, and Uncertainty, seems particularly apropos for our discussions today, and I'm sure we'll hear much more about those issues from him right now. Please.
Thank you very much. It's a pleasure to be here in Austin. Jamie, thank you for organizing this excellent conference and for having me here. It's my special pleasure to follow up on the very inspiring lecture we heard from Yanis over lunch. So, my job is actually to comment on the modest proposal. I will not jump straight into it. Rather, I will provide some background. I will start with making the case that the malfunctioning of the Euro regime was perfectly foreseeable. Now, this may not sound very original, so let me stress that I'm not making the usual argument you hear from US mainstream economists that it's all about structural problems and a lack of labor mobility. That's not my argument. It's somewhat different. Then I will look at certain tendencies towards stagnation and divergence as they played out since the euro was launched. Then talk about the immediate causes behind the euro crisis. And against this background, offer my perspective on Yanis' modest proposal. So the malfunctioning was no surprise, in my view, because the regime is flawed. Two essential flaws. First, nobody's minding the store. Secondly, no coordination, no proper coordination of national policies. Now, what do I mean by nobody's minding the store? First of all, nobody is in charge of managing domestic demand. So Europe has created this giant economy which obviously has to rely primarily on domestic demand growth, but nobody's in charge of managing it. That's very strange. Related issues are that there's no proper lender of last resort. So there is financial integration in Europe, but there is no proper lender of last resort. Also, there is no fiscal backstop, either for the central bank or regarding fiscal policy. Now, this would be bad enough, no proper, no deliberate management, but outcomes are actually not random. Rather, they are biased. They're biased against growth. Now, as far as the ECB is concerned, that should be obvious by now. I've been making this case for 10 years or longer. I think by now there may be few people left who deny the fact that the ECB is biased against growth. As far as the Stability and Growth Pact is concerned, I don't think there is a lack of discipline here. I think there's the wrong kind of discipline. It's biased. It's asymmetric. And the two working together produce something very poisonous. And I will talk a little about that in a moment. Secondly, the lack of coordination of national policies. Now, that's a big story, and the one thing I will single out, we've heard a little about it earlier today, wage trends across Euroland, which I think provided the most serious development that led to the crisis that we are dealing with today. So essentially, those wage trends provided an asymmetric shock that destabilized Europe. And I will make the case that the euro regime actually amplified these kind of divergences. So where does the regime come from? Well, the Maastricht regime essentially is German. And German economics is extremely simple. In fact, it's so simple, it's a little embarrassing. So it goes like this: price stability causes growth. Now, what do you need for price stability? You need fiscal austerity. So it's fiscal austerity that kind of gives you price stability, which causes growth. So very simple economics. Now, strangely, it kind of worked for Germany in the past, but the German authorities have never understood why it worked in the past, the particular conditions that were in place to make it work. So it was obviously not price stability. Price stability doesn't cause, that's nonsense. But relative price stability, so inflation being lower in Germany than elsewhere, which always gave Germany the competitive edge in terms of undervaluation. So Germany, including the 1980s, got away with consolidation, with fiscal austerity, because, can somebody take that call? Because Germany could rely on net exports compensating for German policies. So the German model worked for Germany because and as long as everybody else behaved differently. The trouble was foreseeable that when Germany exported the model and required everyone to behave in the same way, that it kind of would stop working for Germany itself, right? It's much harder to have a lower rate of inflation than everybody else if everybody else is actually converging to your low rate of inflation. So as to the first regime flaw, the counterproductive policy mix that the Maastricht regime produces, I said there was no deliberate management of domestic demand. So once the Eurozone economy enters stagnation, which means public finances deteriorate, you get a situation of a fiscal squeeze, so governments are under pressure because of the Stability and Growth Pact to do all these kinds of things, cutting investment, hiking taxes, and so on. So obviously this kind of suffocates the economy, suffocates domestic demand, but that's not all. You also get the structural symptoms when you cut investment and hike taxes and so on, the structural problems, the symptoms that everybody keeps on waffling about and treating them as causes when they're actually only symptoms. But the particular point I want to single out here is the tax push inflation, which causes inflation persistence. Because that is really what seems to give the ECB the perfect excuse not to care about domestic demand at all. So that's what's shown in the next picture. The blue line is headline inflation, and as you can see, most of the time headline inflation was slightly above 2%. So the ECB was really annoyed about this. But the other two lines, what they show is the red one, excluding energy and food, so a measure of core inflation. And especially over the last few years, we can see that food prices and energy were the main factor responsible for the ECB's target misses. But what I would like to emphasize is the green line, which also excludes what I call tax push inflation, which is inflation caused by hikes in indirect taxes and administered prices. These occurred when the Eurozone stagnated, so there were budgetary pressures, and finance ministers, because of the SGP, went along and hiked indirect taxes, increased administered prices. Now what does that do? Pushes up inflation. So get this, here's the finance ministers who stare at their 3% mark and do everything to keep the budget below 3%, so they hike administered prices and inflation, which pushes inflation above 2%. 2%, that's what the central bankers stare at, do anything to keep inflation below 2%. So they keep the economy stagnating, which again puts pressure on the budget, and the story goes on. Now, can you imagine a more counterproductive macro policy mix than that? where the two key players kind of shoot each other in the foot. Well, that's the Eurozone for you, and that's what it produces. So let me get to the second key flaw. Issue came up earlier, wage developments. 2% should be the norm. That's what the ECB tries to achieve. So in the long run, kind of you should 2% per year nominal unit labor cost growth. That's what Germany's norm was before the euro, including the 80s. That was the old German norm. And that's actually what, if you look at France, very close to it. Italy, not too, sorry, Italy, yeah, a little bit above, right? But the key point is that it was Germany that diverged from its own pre-EMU trend. So when Alan Greenspan recently had this piece in the Financial Times, I responded to it. He made the case that EMU didn't change European dynamics. He made the case that the non-German countries did not change their culture, so we had a continuation of these differentials. What he failed to observe was that, well, some key countries, such as France, and to a large extent Italy as well, they actually converged to the old German norm. But what happened was that Germany shifted a gear lower. So Germany is the main factor, Heiner Flasterbeck made this point earlier, is the main outlier in this whole story. Now, why is this so important? Because it changes persistently current account imbalances. And here you see at the start of EMU in the 90s, fairly balanced, but since then, Germany on one end, everybody else on the other end. And not just Spain, I don't even include here Portugal or Greece or so, it also affected France and Italy. So it's really Germany against the rest. Now, how does the Maastricht regime make the situation worse? Well, this is actually very interesting. So look at the left-hand side, what happens in Germany, where you have fiscal austerity and stagnating wages. Well, that's killing domestic demand, which again puts pressure on public finances. So the finance minister all along keeps kind of chasing the cat's tail, try to cut the deficit, among other things, hiking indirect taxes and administered prices. So Germany was a big factor in the tax push inflation that I mentioned a moment ago. A lot of that actually happened in Germany. Also, real interest rates in Germany will be relatively high, and credit growth will be slow as far as the domestic market is concerned. So what do banks do? Well, they do some lending to German exporters, but who else? So they go out and do lending to US subprime borrowers and Spanish property market developers and the Greek sovereign and so on. So that's where the German banks get involved. Now on the other side, you have the opposite happening in Spain, where you have decent wage growth, so consumption growth, domestic demand is growing. There is no pressure on finance ministers. Spain's budget was actually in surplus before the crisis. So no pressure there. The SGP is asymmetric. Asymmetric, very important. Interest rates are fairly low in Spain, so you get nice credit growth, stimulating the property boom, and so on. So the divergence, the Maastricht regime makes the divergence worse. It amplifies it. And I'd like to emphasize here, again, how much Germany is part of the story. Kind of today we hear a lot about the southern countries misbehaving. They kind of did all the poor borrowing and all of that. Stagnation in Germany, like Germany is, what, 25–30% of the Eurozone. Stagnation in Germany makes interest rates and financial condition across Euroland lower than what they would otherwise be. So even the ECB, to some extent, responds to stagnation in this big chunk of the Eurozone. Not sufficiently to help the Eurozone, the anti-growth bias I mentioned before, certainly not enough to help Germany, but way too low interest rates, way too easy financial conditions in Spain and other peripheral countries. Now, this is not just Spain doing something wrong here. The two things are related. The fact that Germany goes for fiscal austerity and wage moderation is part of the story. Okay, so this just summarizes domestic demand growth in Germany flat. Germany grows on exports only. In the other countries, obviously, well, the opposite has to be the case. Why does this matter? Well, these competitiveness trends are persistent as are current account imbalances. And over time, obviously, the flows change stocks. So balance sheets deteriorate. So we see that Germany built up a nice positive international investment position over the decade. The opposite happened elsewhere in the Eurozone, especially in today's crisis countries that accumulated more and more external debts. So causes behind the Euroland crisis, well, it seems to have all started in the US. Actually, I think we have to be a little fair in this regard because European banks played a big part in, first of all, sponsoring, i.e. financing, the property market boom in the US. This, at the same time, meant that the European banks would have huge exposures to subprime or mortgage risk in general in the US. So when the crisis started in the US, European banks were right in the middle of it from the start, right? There wasn't really something, the US infecting Europe. Europe was part of it. The European banks were part of it from the beginning. Now, not only that, not only in the US, but the same kind of stuff that had happened in Europe from the surplus countries to the deficit countries. So more vulnerability that had built up thanks to those current account imbalances. The real transfers, the goods that Germany shipped elsewhere, that's all water along the bridge, but the debts are still with us, and they cause the problems today. So, the policy response, well, the typical German policy response, austerity. Austerity imposed on everyone else. There is, of course, a slight problem here for Germany because once the private lending of those imbalances stopped, the trade imbalances would have to go away overnight as well. You need the financing to have the trade imbalances. So they had to be kind of replaced by some form of public lending, which is where all the so-called rescue packages comes in to sustain the imbalances, well, until today. A lot of that is actually happening inside the Euro system. The problem with these attempts is that they worsen the debt dynamics. You kill growth, you push up interest rates. That's how you drive countries into insolvency. Unfortunately, that's now happening across Euroland because it's hitting back on the core. So Germany, until now, had kind of fairly good exports thanks to China, but this is all changing now. So it's a problem for the whole Euro area. All right, so here's where the modest proposal comes in. All right, and I think there's a lot of wisdom in this proposal. It's making use of the existing institutions and kind of uses, for instance, the European Investment Fund to provide equity finance for small, medium-sized enterprises. It wants to use the EFSF for recapitalization of banks rather than helping the sovereigns. The sovereign debt part is taking over by this tranche transfer that I just explained earlier today. And as far as the flows, the sustaining of investment is concerned, here's the cooperation between the ECB and the European Investment Bank that is supposed to provide the financing for sufficient investment to make Europe grow again. So can this work? I think it has the appropriate focus on establishing or reestablishing favorable debt dynamics, get growth going, get financing conditions right. That's how you sustain or reattain, I should say, solvency of debtors and Euroland as a whole. Now, Heiner Flassbeck made this point earlier. I think you kind of are quiet on the intra-area imbalances, which are kind of caused by those competitiveness trends. So that part would need to be looked after. Also, I think the comparison between US Treasuries and the Euro bonds that you refer to, like in principle, the reference is the right one. But unfortunately, I think the scheme does not quite create the equivalent of US Treasuries. And that may be a serious shortcoming. essentially because there is no euro treasury behind those securities, and that's a serious handicap, I think. Also, there is some talk about the need for foreign savings to finance investment in Europe. We hear about China today helping Europe. I think this is all much beside the point. Europe doesn't need the savings of anyone. Europe doesn't need China. Europe doesn't need the IMF. Europe can solve its own problem if only it could get its act together. So this part, I think, there is a bit of a conflict here. I could say more about it, but I skip it for time reasons. So the bottom line is that I think the proposal is not quite so modest in the end, because there is the issue, what are those euro bonds actually? Because the nation states remain liable to service them. So people might say, well, isn't this just an accounting gimmick? Kind of you put it on the ECB or a special purpose vehicle balance sheet run by the ECB. Why should the markets trust that parking them there rather than elsewhere kind of should justify much lower interest rates? So I think there is one issue there. The other one issue is there, I think you may have indicated something at your lunch talk, that I think the flow part of it, the financing of investment in Europe, which is crucial to get growth going again. I think we're talking serious numbers here, kind of in good time, I would say 2% at least. In bad times as today, it seems to me we talk about much more. So modest in that regard, not quite, I think. So, and you indicate that you have no illusions about this. The response in Germany would be the standard response, well, this is monetization of debt, so we can't do it. It's going to cause hyperinflation and all the rest of it. That's, of course, all flawed thinking, but unfortunately, this flawed kind of thinking is very important. So, on the one hand, it's not really modest, but I would also argue it's not really immodest enough. So I think ultimately we need some kind of fiscal union, some kind of euro treasury to back the euro. And the irony in this part of the story really is that Germany's beggar thy neighbor policies have so greatly increased the needed scope for a fiscal union, namely by causing those imbalances. Now, Germany could do all this well by simply running those surpluses forever and just handing over the goods as gifts. That would be fine, right? The problem is, of course, that when you create debts, and if you think you can't create debts permanently, well, that's not going to work out. So that's a serious irony in this whole affair, that Germany, like fearing all those consequences by its own conduct, has caused this problem and has made the need for a fiscal union so much bigger. So is there a happy ending for the euro? Well, at the moment, I have a hard time, unfortunately, have a hard time seeing a happy ending, because even though Germany is now talking about a fiscal union, the problem is the kind of fiscal union we would get would be a Germanic fiscal union, which would mean we have this debt break in Germany already, so it would mean getting such a debt break for the Eurozone as a whole, which obviously would not look after the growth part in the story. It would ignore it. It would make the situation even worse. It would reinforce the anti-growth bias in the regime. So how is all this going to play out? Well, given the constraints created by the German Constitutional Court, I think there won't be fiscal transfers across borders. So it's all got to play out by fiscal transfers within German borders. So it's got to be transfers to German banks, and it's got to be transfers through the euro system. So the Bundesbank will end up bailing out the ECB, and the German state end up bailing out the Bundesbank. So the transfers will be within Germany, and well, the Constitutional Court rulings don't seem to capture that aspect. But if they block everything else, if Germany wants to run the surpluses but not provide the fiscal transfers, well, that's the only route out I see. And I stop with that. Thank you.
Excellent, excellent. Boy, I really wish we had more Germans here. Our next speaker is Kunibert Raffer, who's associate professor in the Department of Economics at the University of Vienna. He also is an honorary professor at the Universidad Nacional de Rio Negro in Argentina. And among other things, he is responsible for the RAFR proposal on sovereign restructuring, which I imagine might come up here as well. Do you need help with that?
Yes, please.
Okay, sure.
Somehow I
Why don't
can't.
you get started, and I will see if I can. Is it already up here?
Yes, it's up here. It's this one.
This one right here. Okay.
Thank you.
And we can just view slideshow. There you go.
And then I press here.
Yes, I think so. Just that one.
Good. Well, thank you very much. Thank you, Jamie, for inviting me, and my thanks to all the organizers for allowing me to speak. It's a privilege because, as I can read in my own PowerPoint, speaking at the University of Texas is a privilege. What starts here does have effects. So it says. Now, you might have noticed I am unfortunately not a one-armed economist. But here come the good news. I promise not to use the word "on the other hand." Now, coming to the task, which is the task of someone to give answers, I give a very straightforward answer. It cannot save Europe. Even though there is full agreement on quite a lot of points. You noticed, I did not say it. Even though there's a lot of agreement, not just the sovereign debt crisis, then a need for debt reduction, for a haircut, recapitalizing, etc. I would even agree that if we started from scratch, if all European nations were that young couple mentioned at lunch, now starting with their debt, and a nice mother would help them out, it might work differently. But unfortunately, we are not starting from scratch. We are starting from a situation where very few countries, if any, are below the Maastricht criteria, to put it very politely. Now, this is, of course, a different situation, which brings me to the one problem I have. And this is a problem uniquely of the way the part which I call the Eurobond part, so to say, although maybe there might be some remonstrations against that, this kind of issue of common instruments, because I don't quite understand how it should work. The tranche transfer, apparently inspired by Ireland, which is a totally different case in my view, how would it work? I mean, creditors have to agree if one debtor changes for another debtor. It's different on the creditor side. Any creditor can sell his or her claim to another creditor without the debtor, so to say, agreeing. But how would it work in this case? Would the banks agree? You know, this question did not arise in Ireland because the banks were practically dead. They just didn't say they were. So they had no choice but to agree and to offer to make the transfer. How could the ECB take it on its books forthwith as demanded? I do have problems to see how that would happen, because I harbor doubts whether all the creditors would immediately agree that this may be the case, especially knowing that what happens after that is that they will be forced to write down part of it if they go to the ECB and need liquidity. Now, liquidity, of course, is the next problem. Can the ECB really make a connex between these two things? Can they deny liquidity for the whole economy if banks refuse to take the cut? I think it is a poker where the banks would see the bluff of the ECB, but in the end, the ECB has to provide liquidity. Then what's about constitutional rights, property rights, a taking? Because you cannot, by any stretch of imagination, argue that this would be, inverted comma, voluntary action if you, as after reading Yanis, you know that the ECB rather, leans on banks to do it. And the last point, it's easy to lean on banks, of course, because they depend with their liquidity on the ECB. But what about others, hedge funds, etc.? And what about regulators? Don't forget that Greece instruments carried AAA rating, which, according to the Basel framework, made it necessary, so to say, for banks to have a zero capital blanket, no cover for these instruments, which lured the banks or pushed them really into having these papers.
Now, without changes in the regulatory environment, the same problem, I'm afraid, is going to pop up again and again in the future. Now, I read Stuart Holland and found something very interesting, referring to Franklin Delano Roosevelt and the New Deal. And you see what I have underlined in red. What would be the tranche transferred to the ECB? It would be the central, in whichever dresses, buying up buying out the debts of the member states. So it would be, I think, somewhat of a difference to the New Deal. It would be in a way Eurobonds, as I said, however construed, not direct ones, but indirect ones, especially so because behind Central European institutions, in the end, the member states are still standing. And the Bundesbank is very concerned about their share in the ECB and what they would have to pay in case. Target credits, I just mentioned this, and the discussion on this in Germany. And the next point is, wouldn't any of these instruments, debt guaranteed by a central borrower with a AAA, assumingly, be something like a subsidy in a way to speculators and investors? Would it not institutionalize the predator state? Because on the one hand, there is money for this, but on the other hand, you will say now we have to go down the way to further austerity, to cut down our budgets, to be able to bring down our debts, etc. Because I don't think that there will be a fundamental change in the attitude, the philosophy of most European states towards state debt. Then I'm not really optimistic about the interest rate. I understood from reading you, Yanis, that you were a bit optimistic about the very low interest rate at which one could borrow. But experience from the first bonds by the EFSF shows that interest rate was, to say it undiplomatically, much too high. And I cannot but agree with the German newspaper I quoted, the Frankfurter Allgemeine Zeitung. It was saving Europe's and profiting from it. Some kind of subsidy, you know, to, or what we call corporate welfare here in the States, or inverted welfare, so to say, policy, which I think is not or would not be a good thing. Now, as long as you have the Maastricht Treaty limits, all this would, of course, mean one way or the other a larger burden on the still solvent states, which would mean less and less states solvent according to their own definition under the Maastricht criteria. And finally, and very important to me, there is a political problem with it. If you hear Mr. Trichet, or is it Tricheur, but anyway, Mr. Trichet talking about the EU Ministry of Finance that would restrict the most essential right of a democratic society, of democratically elected members of parliament to vote on their budget. I think we are going in a very, very problematic situation. On the other hand, sorry, I do apologize, but however, I would say I understand economically that if I guarantee, say, I write a blank check for something which can be used by others, as is the intention, you know, now of some of the solutions, I would also like to have some control. And therefore, I think one should reconsider the option of a Eurobond in whichever, you know, kind of appearance it might come around. Now, have a high degree of solidarity with the Greek. They're so nice people. But if we do all this in the EU, are we in solidarity with the Greek? And I beg to agree with Mr. Aldrich in the Telegraph, who sees that solidarity seems to be directed at vulture funds, much rather than at the Greek. And may I quote one of the gentlemen working in this field? And I believe there is nothing else to say. Now, coming back to solving the problem of sovereign insolvency in a very traditional way, time-tested, and unfortunately for nations, the first time not recommended by an economist, I'm ashamed to say, but by a professor of moral theology with a very unusual name of Smith, Adam Smith, by the way, who recommended it as the best solution for anyone concerned. And I think there is a necessity of introducing this instrument, this method, to the last class of debtors to which it's still denied. Now, making it short, talking frankly, this is what I want to say. I hope there is no disagreement here on this floor and in this audience. And I now come to what I mean precisely. What I mean here is this. You see, I put the copyright for this expression as well here. And what are the essential features of this form of state insolvency? Impartial decision-making. I mean, any legal system worth the name does not allow people, one party, to be judge in their own cause. What happens now in Europe and what happened in Latin America before that was that creditors, or some creditors, ganged up and told the debtor what to do, some kind of receivership, which is not, in my understanding, the rule of law. You see the other points. I'll be very brief on the last one, but I'll tell a bit more on the others. Impartial decision-making is not only the cornerstone of the rule of law, but also I think it's essential for good economics. Because if you decide on your own debt how much to give, so to say, as a haircut, you're very likely not to make the optimal decision. So it's always good to have someone else to decide, as I proposed in the 80s already. And there are very few ideas of international insolvency that share this view. Fortunately, among others, Mrs. Kruger now is among those giving me a hand or a lift, so to say, upwards. And their proposal only has one drawback in my view. I would not really trust, or I would rather doubt, whether any European institution really would be fully impartial in the case of a European state. And the record of, say, the EU Commission in violating the Lisbon Treaty with whatever they have done during the recent past does not do much to make my doubts, so to say, go away. Now, coming to respecting sovereignty, I come back to the US. One of my favorite quotes, 904 of Chapter 9, Title 11. This is insolvency for municipalities. These are not sovereign entities, legally speaking, but if you read it, you see sovereignty doesn't protect more than what's protected here. The court's jurisdiction depends on the volition of the debtor, which is similar to international arbitration. The municipality presents the plan. You have debtor in possession, financing, and no trustee or receivership. And, only the electorate can hold politicians responsible. They can vote them out of their jobs if they wish. Protecting debtors and democracy. There is a public interest in the US that the public entity, such as a municipality, can go on functioning and doing, the jobs, the tasks they have to do. And this puts a limit to what creditors can get. They cannot recover as much as would be economically possible. This is very simple to the protection of individual debtors, where you also have this kind of debtor protection things. And you have a participation of the inhabitants, which I like extremely well, because unlike the European Commission, I'm all for democracy. And you see, first, the affected population has a right to be heard, which of course, in the case of a state, would have to be done by representation. You cannot hear a couple of millions. Very good, I think, is the provision of Section 943. And unfortunately for him, Mr. Papandreou seems to have read either this recently, when he came up with the idea of a referendum, or my work. In whichever case, he shouldn't have done this. So if you ever plan to be prime minister, please don't follow him in this respect. And further participation by parliaments could be easily built into the model. Fair and equal treatment of all creditors. This is extremely important. No preference ladder. And it is extremely important because, first, what I already mentioned, that the Basel framework, to some extent pushed banks into these instruments, and on the other hand, made it easier for countries like Greece to get money at too cheap interest rates. I am very much in favor of a differentiation in interest rates, would help countries also in the way of not reaching too high a level of debt. Then the EU bailout increased the debts of Greece fundamentally, and the present proposal, which was, so to say, the political grave of poor Mr. Papandreou, would at best bring Greece back to where they were when the crisis started. Now all the rest is debt, public debt, debt from public lenders that has been built up in an abusive and useless way, trying to solve, inverted comma once again, the crisis. And such loans prolonging a crisis should not be given preference, as they presently are, against other bona fide creditors or nearly bona fide creditors. And arguably, I might say, and I agree with Dr. Bohuslavsky on this, they might even be subordinated to other creditors. And this would also solve a bit of the problem of Greece if it were really 50% of all the debt, not 50% of part of the debt in this case. Improved sustainability would come around by the procedure where anyone can put facts on the table, and the optional case, which I promised to go over very quickly, loan loss reserves that are tax deductible would be very cheap built-in stabilizers, less expensive than all the programs we have had in the meantime. I can speak about this if you're interested, but since it's just an option, so I don't want to enlarge on this. Now, there is no alternative to state insolvency, and if you read this, you know, secret papers, top secret papers, they usually leak. It seems to be a tradition for such papers, so this paper has followed this tradition. Nowadays, even the EU talks about the haircut. It's now official. It wasn't when I sent my PowerPoint. So apparently there is no alternative to some form of state insolvency. And coming now to the very last part of this, oh, not quite the very last, but one part of this PowerPoint. Is it true, would you believe that Greece is a unique case and there will be no other cases after Greece? Well, I believe it in the same way as Mr. Evans Pritchard does. And may I say that all those of you who are interested in prime ocean view property next to Strasbourg Cathedral, please join me after the discussion. I will sell you as much as you would properly wish to buy. Thank you very much. Muchas gracias.
So our final speaker will be someone we already know very well from lunch, Yanis Varoufakis, who was born in Athens in 1961, spent a number of years in various British universities, Essex, Birmingham, elsewhere, and as well as in Sydney, and has returned to Athens, I guess, in 2000, and has obviously been very productive and active since then. And he will now comment on the comments on his modest proposal.
Thank you so much. It is extremely useful to hear these points, especially the criticisms, and I appreciate enormously the opportunity to respond. I shall start with Kunibert first, simply because I think it helps with the flow of the argumentation and feeds into the discussion that we will have afterwards. Now, if our modest proposal was as Kunibert described it, then I wouldn't support it.
Very good.
But thankfully, our proposal is not as you described it, Kunibert. And let me explain what the fundamental radical difference is between the proposal that you criticized and ours is. Firstly, our suggestion regarding debt management does not involve debt buyouts. It does not involve purchasing of bonds by the ECB. There is a profound fundamental difference between servicing bonds and buying them. Also, you made the juxtaposition between the Irish NAMA and our suggestion, and I think that it simply doesn't apply. Our inspiration was not NAMA or anything like it. And you also, in the same context, referred to a process by which the ECB or Europe is going to be leaning on creditors of member states to convince them to accept this conversion, debt conversion. Again, there is no such suggestion in what we're proposing. Finally, you also said that in the final analysis, member states of the Eurozone will have to be behind those bonds. No, they won't. So let me take these points one at a time. Why am I saying that there is no bond buyback involved here? Because there isn't. The proposal here is that the ECB simply says, makes an announcement tomorrow morning, it doesn't have to wait much longer, that whoever owns Eurozone member state bonds, just know that we, the ECB, will pay them, redeem those bonds to you at the full price, face value, at precisely the time frame that is written explicitly in the contract of the bond. Just don't worry about whether you will get your money from Italy, from France, from Greece, that have issued those bonds. We will pay it. We won't pay all of them. What we're going to do is we're going to pay a percentage, that's the ECB now speaking, which is equivalent up to 60% of that nation state's GDP. That is the Mastic compliant part. Now, there's no leaning on bondholders to participate in this. This is like saying, come and get your money. And there is no reason why there has to be any kind of mechanism by which this has to be enforced. I bet you that if you had bonds issued by the Belgian state, not to mention the Greek state, the Italian state, the Spanish state, and take the Spanish bonds. Let's say you have $1 million worth of Spanish bonds, and the ECB was to say that it services the Maastricht compliant part percentage of those bonds. This means that you will get well over half of that money that is due to you guaranteed from the ECB. All you need to do is register with the ECB that you got those bonds, and on maturity, you're going to be paid back by the ECB this amount. End of story. Why would you not want to do that? Who do you trust to give you the money? The Spanish state or the ECB? Secondly, where does the ECB get the money to do that? It was clear in what I said over lunch. The ECB borrows the money by issuing its own bonds. Now, this is the crucial point. This is where we need to discuss, and I can understand a degree of skepticism, which I think I can overcome, regarding why would anyone want to buy those bonds. But we'll come to this in a moment, in response also to things questions and issues that Jörg mentioned. But the point here is that the European Central Bank, as an independent central bank, issues these bonds in its own name. The German taxpayer, the Dutch taxpayer, any taxpayer from the European Union, from the Eurozone, will not be backing those bonds up. Whatever credibility the ECB has, it utilizes in order to back those bonds up in its own name. Now, we'll discuss what credibility it has and whether its credibility will be diminished as a result of that issue of bonds. But that's coming. Now, let me make my second point in response to Kunibert. The point that he made about the banks. Now, if the modest proposal goes ahead, and the banks are involuntarily recapitalized, like we're suggesting by the EFSF, especially if this, no, I'm sorry, this is not the point I was going to make. This was a good point by Kunibert, and I need to refer to it. Just a second, until I need to consult my notes. Okay, the point concerns austerity. Kunibert said that even if the modest proposal is adopted, there will still be an austerian logic that is running through the complete gamut of European Union institutions. Well, there's a point there. You can't teach an old dog new tricks very quickly, undoubtedly. But my hope, and I think that there is a solid foundation for that hope, is that if the modest proposal goes ahead, and the banks are cleansed through this involuntary recapitalization, so they stop operating like black holes that are sapping the energy of the various economies of Europe, and the European Investment Bank is energized as a kind of New Deal agent in order to create a growth spurt, then I don't see much of a problem involved in saying to member states of the Eurozone that now you have to live within your budgets. Now you have to live within your means. To expect, if not balanced budgets, but something very close to balanced budgets. Because remember, what will have happened is you will have centralized the supervision and bailouts of the banks. You will have taken it off the remit of nation states. You will have centralized, effectively, management of aggregate demand through the investment-led recovery program. And then you can say, like you do here in the United States, to the member states, okay, well, now live within your means. Especially in view of the fact, remember, that the European Investment Bank, in its remit, includes all those things that I mentioned, like health, education, urban renewal, and so on and so forth. The third point that Kunibert raised was an excellent one, that firstly, Greece is an outlier. The Greek problem with the debt has been allowed to fester for so long that now it's almost beyond salvation. And it constitutes a special case, even special compared to that of Ireland, to Portugal, and so on and so forth. So a haircut will be necessary in the case of Greece. It's a kind of insolvency. This is completely right. But let me tell you this. If Greece was the only problem, it could have been dealt with in a few nanoseconds by the powers that be in Europe. Greece, in proportional terms, within itself has a huge problem, but within the European Union it doesn't. The only reason why Greece is being allowed to fester to such an extent is because of moral hazard concerns in the context of a crisis that is unfolding, because the European Union is not prepared to do something like what we're suggesting. But if it is prepared to do something like what we're suggesting, then there will simply be a need for some mopping up operation after the debt crisis is resolved through what we're suggesting. The debt mountain and the banking loss mountain will have been shrunk sufficiently to make the crisis go away. And then the mopping up operation will concern what is left of the Greek debt, which is well over and above the Mastic compliant part of Greece's debt. Now, to me, that can be dealt with very easily in two ways. Firstly, by means of some kind of mutual write-off between the Greek state's debts and the Greek banks. A very large proportion of pre-May 2010 debt, Greek sovereign debt, is owned by the Greek banking sector, which is insolvent, well and truly gone, and needs to be recapitalized anyway in order to be revived so that the Greek economy can have a functioning banking system. Now, to me, it's very clear that the European Union, through the FSF, if the FSF does the job of recapitalizing the banks, would simply take over most of the shares of these banks and then recycling them in them, reselling them TARP-like, and in the process, haircut completely, 100% haircut, more or less, of the Greek government debt to these banks. This is a technical operation that should occupy some, few clever people no more than a few hours in one day. And secondly, what you can have is you can have even a kind of insolvency mechanism for the remaining parts along the lines of what Kunibert was suggesting. I think that Kunibert's suggestion is an excellent suggestion mechanism for what happens after the modest proposal is implemented, because then we're still going to have, just like you have in the United States, municipalities and states that go bankrupt. I think there is a great deal of merit involved in Kunibert's suggestion once the crisis is over, but it is not a means for overcoming this crisis. Now, let me go.
3 more minutes.
How many?
3.
All right, that's enough. I will address Jörg's excellent points very briefly. He says that in the end, we're going to need a fiscal union. We will need a federal solution. Be that as it may, I think that we should, as I said in my speech, and I won't repeat it, we should do this after the crisis is over, for future reference. Secondly, if I wanted to add to his correct analysis about the political and the ideological framework within the European Union, that, Jörg, I think that if a miracle happens and something like the modest proposal is applied, the creation of a decentralized Europeanization process whereby investment is centralized, the banking system is centralized, the ECB is given the job, effectively, of becoming the borrower-lender of last resort, the debt manager of the Mastic compliant part of Europe. If that goes ahead, I think that in the end, actually very quickly after the implementation of all this, there's going to be a gestalt shift throughout the surplus countries of Europe. To put it differently, if the modest proposal goes through, the gestalt shift will certainly happen. And then the fiscal union will come up with is not going to be an austerian one, I hope. Do I have 1 minute?
Yes.
So why would people, money players, purchase ECB bonds? Where does the ECB get the credibility in order to sell those bonds, given what my allegation that there will be no shareholders, I'm getting confused here, taxpayers backing up those bonds, no member states backing up those bonds. Look, it's a very simple process. The ECB is a go-between between the money markets, whether the investors are German or Chinese, I don't care, and Eurozone member states. It's a go-between. What it does is it borrows at low interest rates because the German, the Chinese investor trusts the ECB more than it trusts Mr. Berlusconi or Mr. Papandreou. And the deal there is that the ECB will not be repaying itself the money that it borrows, but it will be exacting these funds from the member states at a very low interest rate, and in the fullness of time, these may be 20-year-old to 20-year bonds. So the question then is, the credibility of the ECB boils down to the credibility of the ECB's enforcement power over member states. Now, the IMF can do it. The FSF supposedly is promising to do it. The ECB has a lot more levers and a lot more bargaining power with Eurozone member states in order to ensure, firstly, that the debit accounts it opens for each Eurozone member state has super seniority status. So even if Italy in 20 years' time cannot repay all its debt to the ECB will be the first to be repaid. And secondly, we know that everybody knows, it's common knowledge, that every member state requires the ECB's active assistance in funding the investment projects through the EIB. So this system, to me, has all the elements it requires so that the ECB can credibly tell the world of finance that give me the money, I will guarantee that you will get it back, I will get it from others, so I don't need taxpayers behind me. And you know what? Even though it will never be spoken, everyone will know that the ECB has the printing presses too. And that common knowledge will ensure that the ECB will never need to use those printing presses.
As a historian, I'm always taken when people say something will never happen, because it usually happens. Maybe that's your point. We have some wonderful and thoughtful and very high-level issues on the table here, so I think we should go to questions. I think I saw your hand first, sir.
Yes, I see all this mechanism is to convince the Germans to do something that they don't want to do. Also because, in fact, it's in their own interest, because Germany is not very interested that Italy, for example, become stronger, bigger as industrial countries. They are not very interested that southern countries, Spain, become competitors to the Germans. So this is a fact. So I wonder, in order to implement this, there are two ways. One is that southern European country and France, they go to Brussels, they put your plans forward, they say, this is the plans. If you accept it, we go on together in the euro. We are not talking about the European Union. The European Union is not attached to a specific monetary system. There are already countries that are not in the euro. So we are talking only about the euro system. So the southern European country and France can go to Brussels and say, this is the plan. Do you accept it? If they will not, because they will not, France, Spain, Greece and Portugal, they make their Eurozone without the European Union. At this, they could so reshape their own credibility, their own system, as the Danish small country has its own money system. It's not starving for it. As Sweden has its own currency, it's not starving for it, and so on. So why to push so much on the Germans to... But I think we should ask them to do it, of course. But when they will say no, because they will say no, of course, then you have to recognize that within Europe, there are different models of currency system. And that, I think, would be very realistic, very fair also.
Let's get another one in. I think we have these three gentlemen here. Let's just go in order here. Brief comments or questions, please.
Very brief comment, then. The question has been raised, and Stephen Cohen from Berkeley. The modest proposal impresses me as, what do they say? The devilishness is in the details. And this is full of such details. It's ingenious. And the ingenuity, as just pointed out, all has to do with the core problem. And the core problem is Germany is a democracy. Were Germany to be a proper autocracy, you wouldn't need all of this nonsense. It could be just rammed straight through. All proposals are very difficult to sell to the German voter, who believes somehow he or she is going to pay taxes to support those indolent, corrupt Greek, Portuguese, Irish, other people. That said, so why not give them something? The other half of this argument is the wage differential and the fact, the mercantilist situation. So the obvious, let me call this a little bagatelle attached to a modest, a party favor to the modest, but why ought not the German Confederation of Unions, we heard spoken of earlier, the German government, and frankly, even I think kicking, and not so much kicking, Deutsche Bank, get together and propose a 5% increase in German wages, which would go a long way towards reestablishing this balance and would give something nice to Germans.
Yes, I must say, again, a lot of the points that I'm going to make have been made by other people. Can I say I have one objection to Professor Raffa's proposal for insolvency arrangements. I really don't see why this is why this should be necessary, in particular when you have a country like Japan, which has 230% of its GDP in debts, still manages to finance it perfectly well. In the case of the modest proposal, there are there are niggles about obviously it's not just the financing, but also really it leaves untouched the fundamental problem, which is the secondary market in this debt. But I think even if this were overcome, there's a much more fundamental issue, and that is that if it were successful, we would be recreating within Europe something like the Chinese have, which is a highly politicized credit system, centrally controlled, which is not under democratic control, financing an investment boom. That would be the sort of the successful version of it, with all the risks that entails, i.e. that when the investment boom slows down, you have massive problems. And the other problem with it of if you are going to control the credit system sufficiently strongly to make those bonds accepted within liquid and all the rest of it, you will be creating a very large shadow banking system, as the Chinese have, which will be outside control, outside the control of the ECB, and it would create it would then create very serious problems of credit control within Europe.
Okay, we have two more in this round, Alain and Matthias, and if you could be brief, both of you, because I want to do at least one more round and get this side of the room in.
Yes, I must say I am deeply thinking about the role of the European Central Bank in your proposal. For the first time, as far as I know, a central bank would be obliged to rely on borrowing money. So, if the European Central Bank must entirely borrow pre-existing saving, if the guarantee depends on the state and thereby on their ability to increase taxes, why should we maintain the European Central Bank? I think that the European investment alone could be sufficient. Why maintain an institution unable to create money, unable to fund anything? It should be suppressed.
Good, good. Matthias, you'll be the last on this round, and that gentleman will start the next round. I'm sorry I didn't see you earlier. The lights are making it a little hard for me.
Very briefly, my question is slightly off in terms of what the others have been, which are the specifics of either Yannis or Kurenberg's proposals. I just want to point out just a brief footnote here on what Jan said before. That Japan has a very high debt to GDP ratio. The UK had, at the peak of the Napoleonic Wars, 300% debt to GDP ratio. So debt levels that are in national currency could be very high and still be sustainable. My question is here, I think you know, part of what we discussed in the morning is that there is a political issue: who wins and who loses with this, you know, with this European project. And my question is, you know, what you suggest, which I think it's correctly in general, that the solution involves not defaulting, you know, which is also, I suppose, what you know, to some extent, you know, Jörg was talking about. You know, a solution in which you expand demand. I don't believe the Germans will increase wages. So part of the story is that the German elites want to keep the wages down. So that's part of the story. So what are the political conditions? What do you think are the political conditions that would lead to, you know, the need for the European elites to decide that they must act, they must stop this spiral of, you know, of that collapse? So,
great. So, panelists, I know we have a lot on the table, but if we could have some brief select remarks, because I would like to get more people into. Jörg, why don't you?
Okay. Yeah, the idea of increasing German wages. According to the analysis I offered you, the fact that German wages stopped growing some 10 or more years ago is the key underlying cause of the crisis the Eurozone is facing today. So it would seem that increasing German wages might be an important part of the solution, right? Either German wages go up or everyone else's wages go down. Currently, we're trying the latter, which means deflation, and given the debt burdens out there, it means debt deflation, so kill growth. Financial conditions worsen, debt dynamics make countries insolvent. So wouldn't it be better to increase German wages? Yeah, I fully agree. Problem is that 5% would probably not be enough. Probably should have to aim at a number like 20%. And everybody will say, well, that's totally...
5% for 10 years.
Yeah, okay. So not a one-off, but you spread it out. Okay, so that's... Okay. Yeah, so as Matthias suggested, there's huge resistance against that in Germany, right? So what is the game being played? If Germany wants permanent trade surpluses and the private sector is not doing the lending, then it's got to be public lending or it's got to be transfers. So the whole problem in this whole process is kind of there has been a huge redistribution of income inside Germany from labor to capital, keeping wages down, making Spain and everyone else borrow, so their borrowing was German capital's profits, right? So it's done the indirect way around. It was all working perfectly as long as the boom and the lending continued. Now it's stopped, and now those loans are bad loans, and now it's about how to turn those bad loans into fiscal transfers. And ultimately it's going to be transfers to German banks, or conducted through the Euro system, through the Bundesbank, it seems to me. So it would be a nice solution, but unlikely to happen, I guess.
More optimism from you, Kunin?
Well, I have the difficult task because Yannis has kindly, discussed with me such a lot. And I thank you for the good things you said about my proposal. And I apologize for being doubly handicapped. Not only am I an economist, but I also loitered around law school when young. They kicked me out too late. Now, reading things such as the banks swap their existing bonds issued by debt-stricken states for new ones with a much lower face value and longer maturity doesn't sound like what you described as a guarantee to me from my former legal background. It sounds like a swap. And transfer also doesn't sound like a guarantee. If it were only a guarantee, that would be different. I wouldn't have said what I did say. Now, you might wish to know where I got this from, the modest proposal in 600 words by a guy called Varoufakis, you might know him. And so I relied on what was written evidence. I can quote more. For instance, the ECB can make medium-term large liquidity provisions to the private banks conditional on haircuts. Now, my English was not as elegant as yours when I said they're leaning on banks, but I think it's somehow equivalent, isn't it, if I make it conditional of something. So, I mean, I went by what is written here, and I think I can defend what I said to some reasonable degree. Greece, as we said, is, well, in a way a special case, but I think there's a big difference to Ireland. Ireland was fine until they made the wrong decision to take over the debt of the private financial sector. Greece, to the best of my knowledge, hasn't done that on an equal scale and has the problem all the same. So I think there is some kind of structural difference between the two countries. Well, guarantee, as I said, I would have no problem. And the other problem I have is what would happen after the modest proposal. Well, after the modest proposal, you said Italian debt to the ECB would have super seniority, if I put it down correctly. What does it mean? That means that no one is going to lend to any other Euro country except possibly Germany once again, and Austria, not to have only the poor Germans always alone, because they would think, well, if I lend something to the Greek, to the Italians, to the Spanish, if worst comes to worst, they're going to serve the ECB, they're not going to serve us. Now this would kill, so to say, the sovereign credit market once and for all. Now, I'm particularly grateful for the point about Japan, but I think there is some misunderstanding about what an insolvency is. An insolvency is necessary for someone who's not solvent. Now, if at the rate of 500% of GDP you somehow manage to be solvent, to stay solvent, you don't need an insolvency procedure at this time. It's a bit like if your leg isn't broken, you don't need a doctor, fixing a broken leg. Once it is, in whichever condition, you will need it. However, historical record tells us that the Japanese relation is not the rule. May I remind you, when Argentina defaulted, last big time, so to say, they had a nearly Maastricht compliant ratio of 63%. It deteriorated after that because due to the change in due to the exchange of the currency. But before the exchange rate changed, it was 63%, and it was some months before that. It was slightly over 50 when within the IMF already documents surfaced, that are known now publicly, that said a haircut of 15 to 45% would be necessary. So I conclude from that not all countries are in the Japanese condition where you can carry 200 or whatever % of GDP. And if you are not in the Japanese condition, and I wish you a Japanese life, then you need something to solve it. And I think that a sovereign insolvency, a proper insolvency, is the thing you would need.
Giannis, briefly, and then so we can get more into it, please.
Briefly? Okay, I'll try. Firstly, Kunibert, this is the wrong version. This proposal has gone through 7 versions. You're quoting version number 2. And the one the part that you about the swap is right. This was part of a much earlier version, and it was before we developed the idea of having the EFSF recapitalize the banks. And the idea then was that to have a negotiation between the ECB, the EU, the IMF, and the banks in order to deal with the banking problem. Now, that has been completely erased from the latest version which we're discussing today. So I don't want to defend an earlier, it's like, I don't want to sound extremely up myself, as the Australians say, but it's like, having a debate with Keynes on the general theory on the basis of his early Marshallian writings. So I'm not going to defend this. This is an old proposal. Please stick to the one that I defended today. On the question, however, of superseniority, you have a point. It is true that if the debit accounts that the ECB has opened for Italy, let's say, have superseniority status over all the other loans of Italy, then that might be a reason for investors to think twice before buying new issues by the Italian state. Well, this is something that Germany would like, because it does away with the problem of moral hazard. But let me say this already, the loans that go to fiscally stricken member states of the Eurozone have superseniority status. So the loans that Greece has, or Ireland, that is taken out against the IMF or the FSF, have that status. So we're not suggesting something new. The point here is this: if the crisis goes away, if I'm right, that the crisis goes away because of the implementation of this proposal, then investors will start thinking at a premium of investing in Italian and Greek bonds, assuming that the modest proposal has a sound basis. Now, let me just do a quick round of the very interesting points that came from the floor. Firstly, Bruno, yes, we're trying to convince Germans to do that which they do not want, but let me say that not against their interests. I shall adopt a Rousseau-like line that what we're trying to do is to force them to be free and prosperous against their current prejudices. But, and Stephen, you made also the point, very correctly, that because we live in democracies, we have to speak to the prejudices even of electorates. Let me share an experience with you. Whenever I speak in Germany or in Holland, because they're very similar in that mindset, I have a tendency to look at the audience in the eye and say that it is a scandal that you are being asked to guarantee loans that go to my government, loans that my government can then not use in order to re-energize the Greek economy, and which the Greek government has effectively to give to bankrupt bankers who know they are bankrupt and therefore hoard this money without lending it to the private sector, either in my country or in your country. And what we need is a debt management system where you do not guarantee these loans, but instead the ECB acts and blah, 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 right? It is my experience that suddenly they listen up. When they hear a Greek in particular saying, we don't want loans from you, but we want a debt management system that makes it possible for us to run a balanced budget, then suddenly the mindset changes. Regarding Jan's point, I shall simply comment on the highly politicized financial system that this proposal would create, that he's completely right. But I can't think of anything better, Jan, at the moment. And I think that the worst enemy of democracy and progress in Europe and the world is a free-falling Eurozone, which is going to unleash the powers of xenophobia and discord in a way that we will end up with a highly politicized fascist system.
Good. So we have about 3 or 4 minutes, and we have some people who've been patiently waiting. Yes, sir.
Yes, hi. 2 comments, or maybe even questions. One is that the idea of the Euro bond, or a pan-European bond, is inevitable, because the current process of crisis management is destroying the sovereign bond market as is, even without insolvencies. When you look at what goes on, and measures already taken, measures being planned, it's impossible for anybody to value bonds of European or Eurozone members anymore today, because they've been rendered incredibly complicated. You have all kinds of mechanisms: partial insurance, credit default swaps, purchases by the European Central Bank that are conditional, mutual guarantees that are not enforceable. When you look at what happened in the last 2 years in terms of trying to prop up the bond markets and prevent defaults, they have already tainted the instruments to such a degree that the banks themselves no longer know what the values of the bonds on a daily basis can be, and they have also 3 or 4 different accounting methods to do their mark-to-market accounting. So you have an incredible confusion already in the bond markets, which only makes the panic worse. So I would suggest that currently the sovereign debt market of the European Union is being destroyed cut by cut, cut by cut. And therefore, eventually, it will have to be replaced by something else. It's irreparably damaged. But will not replace it easily Eurobonds by a European Minister of Finance, because such a fiscal union will not come out of this crisis, only after crisis. On that, I agree with Yanis completely. One more question. Why use the European Financial Stability Facility, which you described properly as a kind of a Ponzi scheme, CDS, CDO combination? Why use it as the new institution to regulate banks and recapitalize them? What about the European Banking Authority? What about the whole new infrastructure that the Europeans set up for their banking system?
And then this gentleman, and then Jamie is waiting as well. Is there anyone on this side I've missed?
Yeah.
No. Please, go ahead.
Yeah, just 3 very brief remarks. The first one is Argentina should not be compared with Japan and the other cases as well, because in Argentina and other cases it was external liquidity that was lacking, external liquidity, so dollars, not Argentinian pesos. So these cases should not be confused with any other cases. And as was said this morning, Europe is a very special case because you do not lack foreign currency, but nevertheless you do not have your national central bank. That's a very peculiar case. My second remark is on the debt management by central banks. Well, that is what Yanis indeed says. What we get in the end is debt management by central banks. It has to be backed by the whole tax base of the whole European community. There is no way out. You cannot say the central bank as such is backing anything. The central bank is a shell, is an empty shell that doesn't is printing money. That's the only thing what the central bank does, and nobody will believe that an empty shell that prints money is a backing for in the long term for sovereign debt. So you need then debt management by the central bank, and then you end up in an IMF system with conditionality by the central bank given to the countries, so that the central bank can responsibly, so to say, manage their debt. This is where you end up. And this is critical. My last remark is on the question of how do you convince the Germans? Well, it's a power game. Let's not fool ourselves. It's a power game. If those countries that are affected, negatively affected by the German mercantilism would go together, and I mentioned this morning already, if France would side with the southern European countries, and if they would credibly threaten to leave the Eurozone, to devalue by 40% or 50% or 60%, as Argentina has done, then there would be a clear decision to be made by Germany, either to raise wages and to convince their people that it's good for them to have higher wages, or to get a revaluation of 50-60% overnight, which would destroy German industries, or you get step-by-step revaluation over 10 years or 15 years stretched through higher wages, and then they can decide what they rationally want to do.
Jamie.
I just want to follow up on one aspect of Robbie Gutman's point about that the sovereign credit markets are already failing, by asking about the implications for the CDS market of the provisions in the recent austerity, the recent Greek deal of a 50% haircut, and the proposition that that haircut is a voluntary event which does not trigger the credit event provisions of the CDS. Whether, first of all, that particular piece of legal, shall we say, legerdemain, undermines and impairs the functioning of the CDS, and what the implications of having an impaired CDS market would be for this ongoing decline in the functioning of sovereign credit markets.
Okay, I think that's our last round. I was going to say something myself about why I think the German position is actually quite reasonable, considering that Germans probably look at the fact that they've spent their money wisely from their own point of view, and they think other countries have not. But I won't make that point, or maybe I just did, I don't know. But I'll let the panelists each have the last word.
Want me to start?
Sure.
Okay. I think in Germany there are two fundamental problems. One really is an intellectual problem. German authorities are in a kind of intellectual trap. I kind of referred to this simple German economics earlier, but that is what the authorities believe. And that is what Mrs. Merkel's advisors tell her. Price stability causes growth. Austerity creates confidence, causes growth. A somewhat related story is, well, you need structural reform. Bang, gives you confidence. Bang, gives you growth. So if you have the political elite believing those kind of extremely simplistic economic ideas, and their advisors repeating those stories, then you have a problem. So Germany is in an intellectual trap. It will be very, very difficult to get them doing anything else. So the second problem is, even if Mrs. Merkel decided to do something else, right? And I shouldn't speak negatively about Mrs. Merkel, because I mean we mentioned Sarkozy. You referred to Berlusconi. Mrs. Merkel actually. It's my oh, sorry. It's irritating. Mrs. Merkel actually stands out positively among political leaders in Europe, I would say, which itself is kind of frightening. But so even if she wanted to do something else and get out of that intellectual trap, if somehow that were possible, there are other constraints due to the Constitutional Court's rulings and the powers given to Parliament. So there is no effective way currently to increase transfers. So how is this supposed to work? I mean, this is why they are desperately looking for leveraging up this silly fund and doing all that stuff, which doesn't provide any real solution. That's why they're doing it, because Europe really is in a cul-de-sac, intellectually and institutionally. How to get out of that? Very hard to see.
Well, I stand again corrected, having read the wrong version. I don't think it was the wrong version, it was the wrong proposal, because you seem to have many more proposals than just one.
It's
because
evolving,
if you really speak now of a guarantee, and when you spoke, I did not hear this word anywhere. Maybe I just overheard it. So I was thinking, you were still thinking about swaps and transfers. Because you didn't say guarantee, at least I didn't hear it. Maybe others did. So in that case, I ask you to tell me. And then your version 7, well, is a totally different model in a way. Well, and I withdraw, of course.
This is the one we're discussing here today.
No, not really. And unfortunately, the letter where I asked you to clarify what precisely you meant by transfer, which I meant transfer and swap in the normal way, either my letter got lost or your kind answer to me got lost when I wrote it to you. But so that also didn't help me to come out with the right way. But you see, if it's another version, of course, then I commented on something which, well, wasn't like this. Now, you are perfectly right that super seniority or seniority, whatever, is not new. I mean, the IMF has been breaking the law over decades by getting and being accorded preference over others, even though it's not a preferred creditor. And what they are doing is they're now trying to install another class of preferred creditors, the European institutions. This, and I hadn't time to be more precise about it, could not happen in my proposal, definitely. Because in that case, you see, you would not have these preferred, and you wouldn't have the present problem of Greece. Because then the public creditors would not have thrown and channeled money into Greece over the last year, which has increased the debt burden enormously, and which has led to the effect that with the preference, you rightly pointed out, and the so-called 50% haircut, we are not quite even there where Greece was 1 year ago. So if they had applied happily the rougher proposal, but at least acceptably a proposal made by Gross and Meyer, one of them chief economist of the German bank, a 50% haircut immediately, Greece would have had 60% relation between debt and GDP. And Greece would have been in a much better position than she is going to be during the next 1 or 2 decades. So public money has increased the crisis, has led to damages to the Greek and to others, and should not have happened. So I'm very strictly against any seniority. I think this is something that should not be there.
Okay, I think Giannis.
Now, sorry, I have one point to say about comparing Argentina. A very small point. Well, I think you can compare it. You're of course right that the debt was foreign debt. In Greece it is maybe not foreign debt. We could say that in Greece the initial private debt was mostly under Greek law. In Argentina it wasn't. But there wouldn't be a difference in sustainability between Japan and Argentina if there were not differences in the way the debts were composed. But the point is, as I said, if for whichever reason you can carry 500%.
Fundamental problem here. The one is a problem of international competitiveness, and the other one is a problem of non-trust inside the country, or trust, or whatever.
May I just explain? If for whichever reason, and I mean whichever reason, you can carry 500% of GDP of debt, fine, you don't need an insolvency. If again, for whichever other reason, you cannot even carry 45%, then you need an insolvency. That was my point, nothing more.
Thank you. Giannis, you will have the last word. Now remember, you are the only one holding us back from break, so choose your words carefully.
Let's have a break.
Give us one or two sentences.
Very quickly. Of course, if 2 years ago the Greek debt was written down significantly, then the crisis would have been slowed down. But, Kunibert, it would not have improved the Eurozone's architectural faults. So the second point about Jamie. The CDS market, yes, effectively they've killed off the CDS market by bending to their will the notion of consent, effectively putting the bankers today on the same, in the same camp as Marxists and feminists who always had the problem with the notion of the liberal notion of consent. And interestingly, now they are creating, as I said in my talk, a public CDS. Where is it going to find the credibility? Now, question, yes, you're absolutely right. Eurobonds are inevitable, but not Eurobonds that are jointly and severally guaranteed by member states of the Eurozone. Because those Eurobonds will have interest rates which will be too high for Germany and not low enough for Greece. This is why we're proposing ECB ones. Somebody said that, I can't remember whom, that they would still be backed by taxpayers. The whole system of public debt would be backed by taxpayers. That's correct, since the ECB only plays the role of organizing, of managing debt. But the ECB bonds would not be backed by taxpayers, and that, I think, is a crucial point. And finally, why assign the task of managing and supervising the banking sector to the toxic EFSF? Two reasons. Firstly, because European politicians, once they have created an institution, they are unshakable. You cannot convince them to undo it. It's a question of pride. So what we try to do with our proposal is to find something good for the EFSF to do and to detoxify it, because if you break the umbilical cord between the borrowing and the lending, and effectively the EFSF borrows, however, with whatever kinds of bonds, in order to recapitalize banks from which it will take the money back after it resells the bonds, then you detoxify it. Personally, I would like to see this EFSF go away. But we have it, and we might as well give it something to do that is not creating more damage than it is worth. I think I'll leave it there.
Excellent. Thank you. Please join me in thanking the panelists.